something with the intention of holding it indefinitely, and I mean truly indefinitely, as if you were buying a farm you'd never consider selling. Well, then there are a handful of companies that I'd personally feel very comfortable owning. So let me share 5 such businesses. If I were starting from scratch today with a modest sum, these are the companies I'd invest in and hold through thick and thin, through boom and bust. Because these aren't merely stocks, they're genuine businesses. They are real enterprises producing tangible goods that real people use in their daily lives. And they've been consistently doing so for decades, reliably increasing their dividends each year, demonstrating time and again that they possess something special, something with staying power. Let's begin with a company I know intimately, the Coca-Cola Company. I initially invested in Coca-Cola back in 1988. That's nearly 40 years ago now. And I haven't sold a single share, not one. People often ask, Warren, don't you think Coke's growth has plateaued? Don't you think its best days are behind it? And perhaps they're right. Perhaps the era of explosive growth is over. But you know what? I'm not particularly concerned, because Coca-Cola isn't just selling a fizzy drink. They're selling a little dose of happiness in a bottle. They're selling a moment of refreshment, a small, affordable indulgence. And that's something people will always crave. Think about Coca-Cola this way. There are 8 billion people on this planet, and most consume multiple beverages every day. Coca-Cola boasts hundreds of brands, not just Coke, but Sprite, Fanta, Dasani, Minute Maid, and countless others. If they could just persuade each person to consume one additional Coca-Cola product per week, just one, the financial impact would be staggering. That's the power of massive scale. That's the advantage of having a presence in virtually every country, every store, every restaurant, and they've consistently increased their dividend for 62 consecutive years. Think about that. Through wars, recessions, oil crises, and financial meltdowns, they've consistently raised it. That speaks volumes about the resilience of the business. Now, some argue, but Warren, soda consumption is declining. People are more health conscious these days, and that's a valid point. However, Coca-Cola isn't solely a soda company anymore. They've adapted to changing consumer preferences, offering water, juices, sports drinks, energy drinks, and coffee. They are adept at following consumer trends, and the beauty is that they already possess the distribution network and established relationships with virtually every retailer on the globe. When they launch a new product, it hits shelves everywhere almost immediately. That's their moat. That competitive advantage is extremely difficult to replicate. You simply can't launch a beverage company tomorrow and expect to compete effectively. So, if I were building a portfolio of stocks to hold forever, Coca-Cola would definitely be on that list. Not because I anticipate it tripling in value in the next 5 years, but because I'm confident that in 20, 30, or even 50 years, they'll still be selling beverages, generating profits, and increasing that dividend. And that's good enough for me. The second company I'd invest in is Johnson & Johnson. J&J is a truly fascinating company because it's essentially 3 distinct businesses under one umbrella. They have consumer health products, Band-Aids, Tylenol, baby shampoo, things you typically buy at the drugstore. They have pharmaceuticals, prescription medications, vital medicines for treating serious illnesses, and they have medical devices, surgical tools, implants, things hospitals rely on. 3 very different lines of business, but all within the realm of healthcare, all serving a fundamental human need, the need to be healthy, to feel better, to live longer. And that need isn't going away. In fact, it's growing. Because the global population is aging, not just in the United States, but everywhere. China, Japan, Europe. Older people require more health care, more medications, more procedures, more products. And Johnson & Johnson is ideally positioned to capitalize on that demographic trend. Now, they've faced challenges over the years, including lawsuits and issues with certain products. Every large company encounters difficulties at some point, but the core business remains incredibly solid. They've raised their dividend for 62 consecutive years, just like Coca-Cola, 62 years through every conceivable challenge. And they've consistently paid and increased it. You see, healthcare companies possess a certain degree of pricing power, real pricing power. Because when you're ill, when your child is sick, when you require medicine or surgery, you're not inclined to bargain hunt. You pay what you have to pay. That's an enviable position to be in as a business, and Johnson & Johnson has wielded that power responsibly. They haven't gouged consumers, they've built trust. That's why their brand is so strong. When you see the J&J logo, you associate it with quality, safety, and reliability, and trust is invaluable in the healthcare industry. So, if I were constructing a forever portfolio, J&J would definitely be included. Because people will always need health care, and J&J will always be there to provide it. It's that simple. The third company on my list is Procter & Gamble. Now, P&G is about as exciting as watching paint dry, and I intend that as a compliment. They manufacture soap, toothpaste, diapers, laundry detergent, shampoo, razors, paper towels, the most mundane, everyday essentials imaginable. And that's precisely what makes them such a great investment, because people need these things every single day. You brush your teeth every morning, you wash your clothes, you clean your house, you care for your baby if you have one. These aren't discretionary purchases. You can't simply decide to forego laundry for a month because the economy is struggling. You need detergent, and you're likely to buy Tide because it's effective and trustworthy. P&G boasts an incredible portfolio of brands: Tide, Pampers, Gillette, Crest, Downy, Bounty, Charmin. I could go on and on. And these aren't just any brands. They're the leading brands, the number one or number two in virtually every category they compete in. That's remarkable. It's incredibly difficult to achieve. And once you've established yourself as the leading brand, you have the leverage to charge a premium. You possess pricing power because consumers are often willing to pay a little extra for Tide rather than risk their clothes with some unfamiliar, cheaper brand. P&G has consistently increased its dividend for 68 consecutive years. Think about that, 68 years. That means they were raising it back in the 1950s. Through the Cold War, Vietnam, the stagflation of the 70s, the crashes of 87, 2000, and 2008, through everything. And they've consistently raised it because the core business simply continues to function. People continue to brush their teeth, wash their clothes, and buy diapers. It's not thrilling, but it's dependable. And dependability is precisely what you want when you're investing for the long haul. I think a lot about competitive advantages, what I call moats, the factors that protect a business from competition. And P&G possesses multiple moats. They have brand strength, they have scale in manufacturing and distribution, they have relationships with every major retailer on the planet. They have R&D capabilities that enable them to constantly improve their products and stay ahead of private label competitors. And perhaps most importantly, they have consumer habits on their side. People grow up using Crest toothpaste and continue using it throughout their lives. They tend to use the same brands their parents used. That's powerful. That's a moat that only grows stronger over time. So yes, Procter & Gamble. If I'm building a stock portfolio to hold forever, they're on the list. Not because I expect them to grow at 20% per year, they won't, but because I'm confident that 50 years from now, people will still be brushing their teeth and doing laundry, and P&G will still be there, consistently raising that dividend year after year. That's good enough for me. The fourth company I'd include is McDonald's. Now, some people are surprised when I mention McDonald's. They see it as just another fast food restaurant, not sophisticated enough for serious investors. But they're missing the fundamental point. McDonald's isn't primarily a restaurant company. It's a real estate company that happens to sell hamburgers. Let me explain. McDonald's owns the land and buildings for a significant number of its locations. They then lease those properties to franchisees who operate the restaurants. So McDonald's receives guaranteed rental income every month and also receives a percentage of sales from the franchisees. They benefit when the restaurants thrive, but they don't shoulder all the operating risk. It's a brilliant business model, really brilliant. And on top of that, they're in the food business, and people need to eat. Now, McDonald's isn't fine dining. It's not where you go for a special occasion, but it's convenient, affordable, and consistent. You can visit a McDonald's in Tokyo, Paris, Dubai, or virtually anywhere, and you know exactly what you're getting. That consistency has intrinsic value, real value, and they are constantly evolving. They added breakfast, they added coffee to compete with Starbucks, they offer digital ordering and delivery. They adapt to consumer preferences, they've increased their dividend for 48 consecutive years. And here's what I find particularly compelling. McDonald's performs well in prosperous times when people have disposable income and are buying premium burgers and fancy coffee drinks. But they also thrive in difficult times when people are watching their budgets and need an affordable meal. That's a defensive characteristic, precisely the kind of business attribute you want when thinking about investing for the long term, because you can't predict the future of the economy, but you can be confident that people will continue to eat, and many of them will choose McDonald's. You see, McDonald's has built something that's exceptionally difficult to replicate. They have approximately 40,000 locations worldwide. That's 40,000 individual pieces of real estate, often prime real estate in excellent locations. You can't simply recreate that overnight. You can't just decide to compete with McDonald's and open 40,000 stores. It took them over 70 years to build that. And each of those locations represents a small, localized monopoly on convenience. That's their moat. Plus, they have the brand, the golden arches, recognizable everywhere by everyone. Children grow up loving McDonald's, and then they take their own children there. That's generational loyalty, something money simply can't buy. So, if I'm building a forever portfolio, McDonald's is in it. Not because I think they're going to revolutionize the restaurant industry, but because they don't need to. They've already built something that works, something that will continue to work, and that dividend just keeps increasing year after year. That's what I want. That's what you should want, too, if you're thinking about the very long term. The fifth and final company is Walmart. Now, Walmart is interesting because it's not your typical dividend aristocrat. They've only been increasing their dividend for 51 years, which is still quite impressive, don't get me wrong. But more importantly, they're the largest retailer in the world, and it's not even close. They generate over $600 billion in revenue annually. $600 billion. That's an almost incomprehensible amount of commerce. It's larger than the GDP of many countries. And they've leveraged that scale to create advantages that are virtually impossible for anyone else to match. When you're that large, you have the ability to negotiate with suppliers in ways that smaller retailers simply can't. You can demand lower prices. You can demand exclusive products. You can essentially dictate the terms, and then you pass those savings on to customers, which attracts even more customers, which further strengthens your negotiating power with suppliers. It's a flywheel, a virtuous cycle that continues to spin. People have been predicting Walmart's demise for decades. They're too big. They can't adapt. Amazon will obliterate them. But you know what? They're still here, still growing, still serving millions of customers every single day. And they've adapted. They've developed their e-commerce platform. They offer delivery, pickup, and grocery delivery. They're competing with Amazon, and competing quite effectively, actually. You see, Walmart possesses something Amazon will never have: physical stores. Over 4,000 of them in the US alone. And those stores aren't a liability, they're an asset because people still enjoy going to stores. Sometimes they want to see the product, touch it, and take it home immediately instead of waiting for delivery. And Walmart can fulfill online orders from its stores, which means they can get your order to you faster than almost anyone, same-day delivery, 2-hour pickup, all because they already have the inventory in a store near you. That's a competitive advantage, a significant one. And here's the other thing about Walmart: they serve everyone. Wealthy people, poor people, middle-class people, it doesn't matter. Everyone shops at Walmart because everyone wants to save money. And in economically challenging times when money is tight, people shop at Walmart even more frequently, so they're defensive. Like McDonald's, they perform well in both good times and bad. That's precisely what you want in a long-term investment. Now, Walmart's dividend yield isn't particularly high, perhaps around 1.5%, but they increase it annually, and they have plenty of room to continue raising it because they generate so much cash. And if you reinvest those dividends, if you consistently purchase more shares with the dividends they pay you over time, over decades, you'll do very well. Because Walmart isn't going anywhere. They're too large, too entrenched, too vital to the American economy. In 50 years, people will still be shopping at Walmart. Perhaps the stores will look different. Perhaps they'll be more automated. Perhaps you'll use your phone to check out. But they'll still be there, still serving customers, still increasing that dividend. So, those are my 5. Coca-Cola, Johnson & Johnson, Procter & Gamble, McDonald's, and Walmart. You might notice a common thread. They're all boring. They're not tech companies. They're not going to experience 50% annual growth. They're simply solid businesses that cater to fundamental human needs: food, beverages, healthcare, household products, and shopping. And that's the key. If you're buying stocks to hold forever, you don't want excitement. You want dependability. You want companies that will still be around when you're older, when your children are older, when your grandchildren are older. And these companies have consistently proven themselves decade after decade through wars, recessions, technological shifts, and everything else. They simply persist, continue generating profits, and continue increasing that dividend. Here's what I'd do with these 5 stocks. If I were starting today with a modest amount to invest, I'd allocate equal amounts to all 5, splitting my money equally among them. Then, I'd set up automatic dividend reinvestment so that every time they paid a dividend, it would automatically purchase more shares, and then I'd forget about them. I wouldn't check the stock prices. I wouldn't worry about market fluctuations. I'd simply live my life, work, spend time with family, and focus on the things that truly matter. And every quarter, more dividends would appear and buy more shares. And every year, those dividends would be slightly higher because all 5 of these companies increase their dividends annually. And after 10 years, I'd check and be pleasantly surprised at how much it had grown. And after 20 years, I'd be even more surprised. And after 30 years, I'd be wealthy. Not rich perhaps, but very comfortable. And the beauty is that I wouldn't have had to do anything extraordinary. I wouldn't have had to be particularly intelligent or lucky or skilled at timing the market. I simply had to be patient and allow these businesses to do what they do best. Let Coca-Cola sell beverages. Let J&J heal people. Let P&G clean clothes. Let McDonald's feed people. Let Walmart serve shoppers, and collect my share of those profits in the form of dividends. That's it. That's the entire strategy. Now, people will inevitably ask, but Warren, what about technology? What about AI and electric vehicles and all the exciting new trends? And look, those things are undoubtedly important. They're likely to reshape the world. But I don't possess a deep enough understanding of them to confidently bet on them. I don't know which companies will ultimately emerge as winners. But I am confident that people will continue to drink Coke, use Band-Aids, wash their clothes, eat hamburgers, and shop for groceries. That I understand, that I can have confidence in, and that's what truly matters. Not necessarily finding the most exciting stock, but identifying stocks you can have unwavering confidence in. Stocks you can hold through anything, through market crashes, panics, bear markets, and recessions. Because if you can't withstand the tough times, you shouldn't own it during the good times either. You see, investing is simple, but it's not necessarily easy. The simple part is identifying solid businesses, acquiring them at reasonable valuations, and holding them indefinitely. The difficult part is actually holding them indefinitely because the market will inevitably decline at some point. Your stocks will likely decrease in value, perhaps significantly, and everyone around you will be panicking, selling, and proclaiming that this time is different and that the world is ending. And you're likely to feel frightened, really frightened. But that's when you need to remember what you truly own. You don't own mere pieces of paper. You own parts of actual businesses. And those businesses are still producing Coke and Band-Aids and Tide and Big Macs and selling groceries. They're still serving customers, still generating profits, and still distributing dividends. The stock price might be declining, but the underlying business remains healthy. And if the business is fundamentally sound, the stock price will eventually recover as well. It always has, anyway. Well, I think I've covered everything I wanted to. 5 stocks to hold forever: Coca-Cola, Johnson & Johnson, Procter & Gamble, McDonald's, and Walmart. Not because they're flawless, not because they'll never encounter challenges, but because they're resilient, because they've proven their ability to endure anything, because they address fundamental human needs that aren't going away, and because they've consistently rewarded shareholders with increasing dividends for decades. If you're young, if you're just starting out, these are the types of stocks you should be buying, holding, and then largely ignoring. Don't check them every day. Don't obsess over what some analyst on TV says about them. Just hold them, reinvest the dividends, and be patient. Because patience is the ultimate secret. It's always been the secret, and it always will be. You know, I'm 94 years old now, and I've been investing for over 75 years. And the most important lesson I've learned is that it's not about being brilliant. It's about being sensible and patient. These 5 companies are sensible investments for sensible people who are capable of being patient. And if you can do that, if you can buy them, hold them, and simply let time pass, you'll do